What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Lyn Alden of Lyn Alden Investment Strategies. Lyn, welcome back. It's good to see you.
Glad to be back. Thanks for having me.
Yeah, well, I wanted to spend this time sort of revisiting your forecast for 2021, right? All analysts put out their forecasts in December and January for the upcoming year. You did a phenomenal one on a Real Vision TV that was just published at the end of February, but I know it was recorded in December. And so lots has changed, right? It's been a pretty crazy year, very, very busy. And I'm curious about what may have changed in that you covered, your thoughts on the US dollar, interest rates, inflation, commodities, the emerging markets trade, real estate, gold, Bitcoin, a whole variety of things. We only have about 20 minutes. So we won't get into all of it with as much depth. But first of all, everybody should watch that on Real Vision TV. It's excellent. But I want some updates from you today. And so maybe let's start with the US dollar. You had a very bearish outlook in 2020. Obviously, that paid off. And now, if I understand correctly, you're pulling back on that a little bit because you're seeing that trade become a bit crowded. Is that correct?
Yeah, pretty much. Starting in late 2020, I started to become less decisive about that, at least in the intermediate term. So I still have a longer term view that we're probably in a more structural dollar bearish cycle. But during that process, you're going to probably have counter rallies along the way. And so whenever it gets too crowded, too consensus, it's easy to have a surprise that pushes it up. And so far, that's what we've seen here in early 2021, still getting used to that, is that we're having somewhat of a rally in the dollar. Now, with the FOMC, press release today, we did get a little bit of a pullback in the dollar due to Powell kind of pushing back, being a little bit dovish. It's possible that can start a reversal. But until we see some kind of major hurdles crossed, I don't really have a ton of conviction in the near term about the direction of the dollar. And so, I'm kind of focusing on other topics of the moment and kind of just waiting until the market gives me more signals on that.
Got it. Yeah. I mean, I know you mentioned 3 to 6 months uncertainty. Any hurdles come to mind, Lyn? What would you be looking out for to go one way or the other that'll increase or decrease your conviction?
Well, a couple of things. One is just price levels. We'll see if it starts breaking firmly above, say 92 on the dollar index. And we're seeing some weakness in Europe related to the vaccines, related to their various policies, and because the dollar basket is very euro heavy, that weighs on it. And so that's a pair that I'm a little bit less convicted on. The main thing I'm watching though is yields. And so as we get higher inflation expectations here in the United States, we have other central banks that are kind of taking the turn of being more dovish, and so they are. Some of them are doing yield curve control. Some of them are doing kind of indirect yield curve control, where they're more explicitly saying that they're not going to let long end rates rise too much. Whereas the Fed has purposely been a little bit, more kind of balanced on that, and not really showing at least any concern about the long end of the curve until the market probably forces them to. And that's kind of something we've seen out of this Fed, is that they've been very reactive rather than proactive. And so rather than trying to get ahead of things, they wait until the market kind of has a pain point and then tells them what to do. And so they're kind of moving forward with that and saying that they're remaining very dovish on the short end of the curve. They're keeping their QE in place, but they're not really overly concerned about the long end of the curve right now. And that can keep somewhat of a little bit of a floor on the dollar.
Does that concern you, Lyn, that reactive nature versus the proactive planning from the Fed?
Not exactly, because it's all about essentially market manipulation. And so instead of kind of getting ahead and manipulating ahead of time, they're at least kind of letting the market poke around a little bit before they come in and quash it. So I guess it depends on what your view is on that. I mean, if you have a certain outlook, you'd rather them just kind of rip the Band-Aid off and do what you want them to do. But if you're kind of just watching market forces play out, in that sense, you want a Fed with a lighter touch. And it's all relative, right? Because they're still holding rates at zero. They're still doing, billions and billions of QE per month. And so it's, what exactly is tight versus getting ahead of it it's a relative game. You're basically comparing it to other central banks, and you're comparing it to the massive amount of fiscal spending that's happening and how much of it they're going to have to monetize and how much they're going to have to control rates.
Okay. Last question on the dollar. Just a month ago, I had Peter Schiff and Brent Johnson back on the show, and they were debating, the dollar for 2021, renewing a bet they made in 2020. So they've got a 1 ounce gold coin riding right now on whether the dollar will be higher or lower. I guess it would be like January. It was the final week of January they hosted this. I have to recheck the exact date. But anyways, it was around 92 and it was the 4th week of January. Any prediction? Obviously, Brent's betting the dollar is going to rise. Who's going to take home that gold coin in 2021?
I'd have to lean bearish on that. But again, until we have more signal, that's not one of my higher conviction areas. I was more conviction last year. And I still think longer term, we're going to see a dollar weakening cycle. But it's always possible that 2021 ends up being a kind of a neutral year or, mildly up, mildly down. If I had to pick one, I would say probably neutral to down.
Got it. Okay. Now you mentioned higher inflation expectations. You're expecting the Fed to hold rates at zero. Is that correct or not? Yeah. Okay.
Yes. Yeah. And they've indicated them as well, but the market's beginning to test that theory, and they're basically kind of pricing in some rate hikes happening in a year or two. And Powell today pushed back against that, and basically they don't plan to raise rates until they have persistent inflation over 2% as the way they measure it. So people can debate about what is the correct way to measure inflation, but we know that basically what the Fed is using is their model, and so. Overall, they seem pretty intent on staying dovish for as long as possible. And there's going to be a couple tests along the way. And so one of the big ones to look out for is that in quarter two, specifically April and May, the inflation numbers there, and they'll be reported in May and June. But the reason those are significant is if you look at what CPI did, it took a really big dip back in April and May because that was kind of the heart of the shutdowns and the big disinflationary period. And so when you do year-over-year comparisons, those are really low base effects. And so there's a decent chance we're going to get a CPI print that's over 3% in April or May, probably both. And so, but Powell already referred to that. He also already said they're going to call that transient. And so you might have a mismatch between what the bond market's doing and what the Fed's looking at. And so, we'll see if things get a little bit disorderly around that time. But the Fed's already aware of that, talking about that. And so it's something that's kind of the next time period that I'm monitoring.
Okay. Thanks for that. Now, just to touch on that. So, we're expecting inflation to run hot. We're expecting the Fed to continue to suppress rates, creating this, negative real rate scenario, which is typically a great setup for gold. If that's the consensus, are you surprised that gold hasn't performed better since August? It's been a very soft market.
Not really. It's been, I guess, slightly weaker than I would have expected, but overall, it's pretty much doing what I'd expect from the 10-year doing what it's doing. And so a lot of people focus on the shorter end of the curve, but because gold is generally a longer duration asset, it's best to compare it to other long duration assets, such as the 10-year Treasury or longer. And so if you look at the real rate in the 10-year, ever since August of 2020, we've had nominal rates rising faster than inflation expectations. And so you've had a rising of real yields that are still negative, but less negative than they were at their bottom in August 2020. And so even though if you look at, say, earlier in the curve, like the 5-year, you're getting kind of a wider, kind of a more negative rates. If you look further out at the 10-year, that's where you're kind of getting some solidity there. Now, I do think that as we go forward a little bit, we'll get, inflation expectations probably catching up to that. And we might have seen kind of a rollover where gold kind of finds a bottom, real rates find a top. We have to see a little bit, more conviction on that. Right now, it's kind of a potential turning point that I'm kind of monitoring that we might see a little bit of a decoupling here and gold kind of find its legs a little bit. But kind of the ultimate long-term thing is the potential for yield curve control or things like that. But the Fed's unlikely to move on that until things get disorderly enough that the market's essentially demanding it. Until then, they're basically keeping the short end tight. They're letting the long end rise. And so gold's kind of in a mixed condition because the gold really kind of focuses more on that long end.
Got it. Okay. Now I have to ask because it's a common conversation these days, specifically from gold bugs more so, that Bitcoin is eating gold's lunch right now, right? As the asset, the role that gold used to play, a lot of that dough is now moving towards Bitcoin. Do you have any thoughts on that, Lyn? Does that resonate with you, or do you think that's missing the point?
I think around the margins, it stole a little bit of the narrative. But if you look at, if I just looked at what gold, if Bitcoin didn't exist, and I'm just looking at what gold is doing compared to 10-year yields, nothing stands out as unusual. Now, it might be on the weaker side slightly of what I'd expect. Maybe it's $100 lower than I think it should be. But overall, it's roughly following what I would expect from money supply growth and from those 10-year real yields. And so, it's possible that Bitcoin's responsible for the fact that it's on the weaker side of what I'd expect rather than, say on the stronger side or kind of average. But overall, it's not really doing anything enough that I would call it deviant from how I'd expect gold to be behaving in this 10-year environment. Now, overall, real yields rose a little bit quicker than I would have guessed, say 6 months ago. And so gold's been slightly weaker than I would have guessed 6 months ago. But comparing those two measures together, it's making sense as gold relative to real yields. But because we're getting such strong action in Bitcoin, and because younger investors are generally using, Bitcoin more like that gold proxy, we are probably getting some money flows that would have otherwise gone into gold and silver instead directed towards Bitcoin. But I view it as a big mix. And so some people are only one camp, only the other camp, whereas I like Bitcoin, I like gold, I like silver, I like copper, I like uranium. And I kind of just tilt them based on, what's getting out of hand. And so, for example, last summer, I was still bullish on gold, but I started rotating more and more into, some copper, some Bitcoin, things like that are a little bit more of that kind of kind of inflationary bent to them. And those have done well. But for example, copper, I think is, it's gone up pretty far, pretty fast. And so it's starting to look a little bit more interesting towards gold again.
Okay. Thanks for that. Now I want to jump into a lot of the commodities that you just mentioned. One final question on Bitcoin, though, just because I know your thesis remains fairly bullish, right, for 2021. And from my standpoint, like what I do is gauge sentiment, right? I have conversations like this for a living. I talk to a lot of retail investors, and I've seen the sentiment shift in Bitcoin, and I was waiting for this shift. I knew it was coming, and now I feel like it's here. Where I don't want to call it retail euphoria, but we're getting close. I mean, people like Lindsay Lohan, for example, are calling out now saying, if you don't own Bitcoin, you're an idiot. And those are the flags that you got to look for, right? So are you seeing those flags? Are you concerned that we're sort of reaching a frothy top or not? Does it not bother you?
So I think we're firmly bull market. I mean, it's certainly a popular trade at this point. My base case is that trade's not over yet, that Bitcoin probably still has more to go in this cycle. Potentially, for example, when we see some of those 3% CPI prints, like I mentioned, in quarter two, I still think there are a variety of kind of catalysts ahead. That the TGA drawdown, the stimulus checks going out, the potential for 3% CPI prints, and so and looking at just a variety of on-chain indicators. Basically looking at what long-term holders are doing. You can generally see these patterns play out with Bitcoin, and so far the underlying fundamentals still look strong. And as another example, Bitcoins are still leaving exchanges, meaning that there's still kind of a net outflow where people are buying Bitcoins, putting them in cold storage. And so overall, this huge price increase hasn't yet been enough to get long-term holders to basically dig their coins out of cold storage and sell. But it started to happen to some extent. We saw some profit taking in a little bit in recent months, but nothing that yet would suggest a major top's in place. But of course, it always remains to be a possibility. We can't purely go on what fundamentals are doing, what past performance, because ultimately sentiment can dictate a lot. Another thing I'd point out is that a lot of the kind of the altcoin space has taken some of the really kind of frothy elements. And so, for example, we've seen intense euphoria around NFTs, and some of these kind of utility protocols. You could say like some of the Ethereum competitors, and DeFi was big for the past couple of months. Now it's kind of been replaced by NFTs in sort of the narrative. But overall, I think that's where a ton of the really retail speculation is. Whereas Bitcoin, ironically, a lot of the retail people are saying that Bitcoin's not fast enough for them, that they want to go into that kind of wild west of the different types of tokens. Whereas, institutions are the ones that are still loading up on Bitcoin, as well as some of the more kind of, dedicated Bitcoin investors. Okay.
Two more questions on this one. Purely from a speculation standpoint, 2021, are you choosing Bitcoin or Ethereum?
So that's tricky because during a Bitcoin bull run, a lot of times those other protocols actually outperform on a percentage basis during the bull market. So I don't really have a high conviction between the two during 2021. I would lean towards Bitcoin if you talk about multiple years to include, say, the bullish run and then whatever pullback we're going to get.
Right.
So that's my preference as a protocol. But during that up phase, who knows?
Okay. And I guess that answers my second question. I was wondering about time horizon. If you're looking for an exit point this year or in the next sort of 12, 18 months in regards to your Bitcoin position, but it sounds like not, right? You're holding for the long term.
Well, so I think, there's basically a difference between a strategic holding and a tactical holding. And the same thing's true for gold. So, for example, someone might have physical gold as a strategic holding that they don't really plan to sell for the foreseeable future. And then they might have gold miners or gold ETFs that they're using as a tactical play because they're bullish on a certain time period. And so I'm viewing Bitcoin similarly, where I think probably later this year is a good exit point from a tactical standpoint, or at least to basically rebalance the position and not become super overweight that position. Right. And I treat different types of Bitcoin holding differently. And so, for example, in one of my model portfolios, I already sold a small tranche of the GBTC that I hold in that portfolio just to stop that from becoming such a big chunk of the portfolio. And so we've already actually, taken more profits than we put in. So the whole rest of the position is just a free riding position. And it's still a pretty big chunk of that portfolio, but it's not, I'm not letting it get too big of a percentage because a lot of people kind of follow that portfolio. For some of my other holdings, like my cold storage holdings, I don't plan to sell those, just yet. And so I kind of separate that strategic holding from kind of another portion that I'm willing to rebalance or kind of trim in certain tranches to not be overweight too much.
Okay. We're going to switch gears to commodities now, and I want to start with uranium, Lyn. So, are you positioned, and if so, how right now?
So I'm bullish on uranium. I wrote a report in October 2020. That's right. I then established my positions and became bullish on it. And so I played it somewhat conservatively with, I have a pretty decent chunk in the, the holding companies, the ones that just hold uranium. They were at the time they're trading at a discount to NAV. Now, even though spot uranium's gone nowhere, the discount closed and turned into a mild premium. And I'm also bullish, say Cameco. I also think the ETFs are a decent way to play it. And so overall, I'm bullish on the space, but I leave, kind of specialists to pick through the different types of junior miners and find out how to get the most explosive gains. That's kind of you need a lot of specialty to really kind of dig into those and follow those well. I'm sure you've had them on your show.
Yeah, for sure. Now, when it comes to uranium, do you factor in public perception of nuclear power into your thesis? Because the reason I ask is because for my entire life, it's been pretty negative, right? Nuclear power has been stigmatized as a dangerous power source, and it's an amazing technology, right? The energy produced per square foot, the zero carbon emissions. There's lots of reasons to love it. There's been some horrible mistakes made, and that's where the connotation comes from. But do you factor that sentiment into your uranium thesis, Lyn?
To some extent, and the reason that I don't focus on it too heavily is because a lot of the demand's coming out of Asia. Yeah. So going forward, a lot of the reactors are going to be built in China, India, South Korea, Middle East, Eastern Europe, places like that. Now, so the major tail risk I'd look out for is if we have like a fourth major nuclear disaster that basically pulls some of the existing reactors off the market in a big way, right? So a handful of reactors here doesn't matter, but if a major country like we had Japan pull all the reactors offline, if that were to happen to the United States or France or something like that, that would really kind of derail the bull market thesis. But overall, just from the numbers being built compared to the supply, basically regardless of what Americans and Europeans think about nuclear, just the numbers kind of suggest very long-term bullish here. Now, in terms of sentiment, it seems like it's changing in the better. And one thing I point out, if you look at India, they still have like 2/3 of their grid electricity being generated by coal, right? So, people can debate about, what's cleaner than what else, but I mean, there's no debate that coal is pretty much the dirtiest major fuel source out there, and their usage of that is still growing, and they have some of the, if you look at, say, air pollution in major cities, it's a pretty big problem throughout Asia, including India, and so they have a pretty big incentive to at least want to take a segment of that and put that into nuclear energy. And one thing I point out in terms of the overall environmental and safety profile is that all these different types of energy sources have risks. And, nuclear is kind of like, it's comparable to an airline. And so, for example, a lot of people are afraid to fly on planes. If a plane goes down, it makes world headline news for weeks. Whereas statistically, it's a far safer mode of travel than cars. We don't really think about cars too much, but that's because there's no disaster that makes like world news with cars. It's always these small things kind of building up over time. And so with coal, if you look at the studies, I mean, there's like hundreds of thousands of deaths attributed to basically the burning of coal and other sources and causing particulates to be in the air and exacerbating health conditions and causing death and illness. Whereas if you add up all the deaths associated with nuclear energy, including the long reach ones, so very few people died from the actual meltdowns, but then if you include even the high range estimates for the long-term health effects from radiation and stuff, it still comes nowhere near coal over those decades. And so overall, if you just run the numbers, it is a pretty safe and clean energy source.
Yeah, I think you brought up the most important point there, and that's that if you're not choosing nuclear, you're not choosing solar or wind, you're choosing coal. That's the reality of our energy production today. Okay, let's stick with energy then. So talking about the renewable energy transition in the US, outside of copper, Lyn, are you looking at, and outside of nickel, are you looking at any rare earths, lithium, cobalt, anything like this?
So I don't go too heavily into that. And I am generally strategically bullish on a variety of those. But again, kind of like, say, junior uranium miners, it's not an area that I pick out. But it is well known that cobalt is important for electric vehicles, and at least as they're currently kind of designed. But I've really focused pretty heavily on having a broad distribution. So I like copper, I like nickel, and I like it when a company has a cobalt mine or a cobalt stream as part of its production. And so that's kind of how I'm playing it. Is kind of a scattershot, broad approach.
Yeah, okay, that makes sense. And so then staying high level, precious and base metals, maybe you call it silver, copper, nickel. Any that you're most bullish on for 2021?
So for 2021, not specifically. I think copper came really far, really fast. So I turned increasingly bullish on copper in kind of the summer, and we've had a stronger rise than I would have expected. Those positions have done really well. So I've been somewhat paring them back, even though I'm still long-term bullish. It's just a matter of kind of risk management. Right. And I wouldn't be surprised to see consolidations or corrections there. So I guess I'm not super bullish on copper in the near term. But if you're kind of really kind of focusing on, say, a 6 to 12 month outlook, technicians can probably give you a better answer than me. I'm kind of looking at more of like the multi-year outlook. But I remain very bullish on uranium, very bullish on silver and gold. Pretty much most of those metals, and maybe a little bit more concerned about copper just in the intermediate term.
Okay, and final vertical I want to touch on is emerging market equities. So talk to me about timing and your outlook when it comes to emerging markets.
So one thing I do is I separate them into different markets. And so, people often look at that, the basket, the MSCI Emerging Market Index, and that's, market weighted composition. But you have very different countries in there. Russia and India have very different demographics, just very different markets. Then you have China compared to Chile. This just couldn't be more different in terms of what kind of companies they have, what's happening there. And right. So I really look at things on a country by country basis. The one thing that they mostly share in common is that they're an inverse dollar trade, because a lot of emerging markets, they rely on external funding. They have dollar denominated debts, and so when the dollar is inflating, when there's basically the dollar's weakening compared to a basket of foreign currencies and weakening compared to hard assets in general, emerging markets tend to go along with that dollar bearish pro commodity trade. And there's some more than others. And so, for example, Russia, for example, has less dollar denominated debt. I mean, they've really kind of de-dollarized to a pretty good amount. But of course, they're very dependent on energy prices. That's their big connection. Whereas China, on the other hand, they're more technology focused, and with them, it's kind of about monitoring, what the basically the authoritarian leadership is doing in terms of, they go through these cycles where they want to grow, but then you start to get overheated, over leveraged, and it's basically well known they have a pretty big corporate debt bubble, and they always kind of try to prevent that from getting out of hand. And so they go through these periods. It's like if someone's like bodybuilding, they'll bulk up and then they'll cut back a little bit and bulk up. And China goes through these cycles where they grow and then they put on the brakes a little bit. And so you kind of watch those cycles for China. But overall, I am bullish on some of the Chinese equities. Pretty much I'm bullish across the board, except places that have a ton of dollar-denominated debt. So I'm more concerned about, and I generally like to avoid that risk. I'm also actually pretty bullish on Japan, even though it's not an emerging market, partly because Japan's companies are pretty global in scope. A lot of them do work around the world, including in emerging markets. And so, for example, one of the ways that I'm kind of trading emerging markets is actually to have some of the Japanese trading companies that are involved in commodities, that are involved in infrastructure projects and all sorts of industrial projects for a variety of countries.
Okay, excellent. Look, Lyn, it's been great catching up with you. Thanks so much for making the time. I know you're crazy busy. You must be the hardest working macro analyst in the business this year. So it's been great having you back on. I appreciate it.
Yep. Thanks so much for having me.